Okay, next we're going to look at what happens if we relax that assumption about growth rates. So it's not zero growth rate, and it's not a constant growth like 6%. What if it varies a little bit for the first few years and then stabilizes? Here we have a scenario where we have a multiple stage growth of 30, then 20, then 10, then stabilizing at 8. And here I'm calling this NPV meets DDM because we're using dividend discount model, which starts with a very simple assumption or a simple method of taking dividend divided by rate of return. And then now we're doing this large NPV type of thing, right? So NPV meets DDM. All right, so we're going to forecast dividends for horizon and then look at a constant growth thereafter. Then we're going to take the value of the horizon. It's very similar to the free cash flow method. And then we do the PVs of each of those flows and get the sum of those to get to a value. And we'll do this, guess what, in Excel. All right, so here we have the model where we have a dividend growth rate that is 30, 20, 10, stabilizing at 8. And then we can then derive the dividends for years 1, 2, 3, and then beyond, which is getting us to a horizon value once again. So let's start with deriving dividend. We take last year's dividend at T0 times, guess what? 1 plus the growth rate. And we do that for the next 2 years. That gets us to $1.97 at year 3, and we need to go out to year 4 to move at this horizon value. So we take the dividend from year 3 times, guess what? 1 plus the long run growth rate, in this case 8%. And we take the required return of stock minus the long-term growth rate. So be careful we get the right rates here. So required return is 13.4 minus long-term growth rate of 8. 13 minus 8, yep. And now we can do the math of dividend divided by this denominator is 39. All right, so similar to what we did before, we'll do present values. So let's start with year 1's dividend. So it's that divided by 1 plus WACC, or required return rather. It's not WACC, raised to the first power. Okay, so it's just that. Next, we take year 2 divided by 1 plus the required return, raised to the second power. Okay, next we take year 3 divided by, open parentheses, 1 plus required return, raised to third power. All right, and finally we take the horizon value, which is 39, and the factor is plus 1 plus the rate of return, 13.4 raised to the third power. And if we sum those, equals sum, we have $31.13 per share. All right, so this is a method where I call this DDM meets NPV or even FCF because we're using an uneven estimate of the growth in dividends, and we're then stabilizing it after year 3. And from that, we derive the set of PVs, which is the present value for the dividends, which is the value of the equity. Almost home. So learning objective 2, DDM, we have some key assumptions such as the dividend estimates for next year, required return on equity, growth rates, However, derived, no growth, constant growth, or multiple stage growth. We see, as I've mentioned, that this is most suitable for large, mature, dividend paying, and low PE stocks. Once you start moving away from these set of characteristics, it's just less and less applicable, and we move toward a free cash flow valuation model. And the weaknesses is private companies. We don't have CAPM. We don't have security market lines. So you can't get a required return very easily for a private company. Second, if a company doesn't pay dividend, well, don't do DDM. It has no dividend. Theoretically, you could do it for a company with no dividends. You'd have to project at what point they do pay dividends. And of course, that is the behavior of a growth company. They often pay no dividends until they stabilize, at which time they begin paying dividends and go from there. But again, use the FCF. Third is high variability, where high variability would lead to just all kinds of erratic behavior in dividend policy because of the cash needs of the company. And the last is, we haven't talked much about this, but if a company has excess cash, they have choices of what they do with it. They can keep it for future growth, they can pay a dividend, or they can buy back their stock. And this is really in vogue right now because it's seen as a non-binding. So, for example, if a company makes a lot of money, they could start paying dividend, but if they were to stop paying dividend in the future, it would look bad. So this whole signaling effect is in play. However, if they make a lot of money this year and they said instead they're going to buy back stock, they convey value to the shareholders by reducing the shares outstanding, thereby increasing the stock price. That would lead to value creation for the shareholders. So, and of course, DDM does not cover that. So several weaknesses. We can use the FCF in more instances for private companies, divisions, or those with little or no dividends. And then we need then financial forecasts. And that's why much of the financial analysis done on Wall Street or in private company valuations is so focused on financial statements and financial projections because they want to derive their best estimates for free cash flow.